Welcome back to Coffee and Capital. And if it's your first time here, welcome. Happy to have you joining us. Today, we're joined by Jeff Cherry, Managing Partner of Conscious Venture Partners. As I'm sure he'll share, Jeff works with private investors and early stage companies with the goal of creating businesses that operate at the intersection of profit and purpose. Really appreciate him joining us this morning.
Okay, thanks, Jake. First of all, thanks to you guys at Science Sense for having me here. Please send my best to Tiffany because if it wasn't for her, I wouldn't be here. I'm glad that you guys, she's a really, really fantastic asset. So great addition to the Philadelphia startup ecosystem. So I'm excited that she's there. She's closer than Atlanta, so I get to do some more work with her. And I've got some, as you can tell with Chris and Joe Carlini and a bunch of other folks, some pretty deep connections to Philadelphia. So we've been thinking about how to get more engaged in the Philadelphia ecosystem. So I'm glad that they'd be able to do this morning. So as Jake said, my name is Jeff Cherry. I am the founder of a thing called Conscious Venture Partners and the Conscious Venture Lab. The Conscious Venture Lab is an accelerator for early stage entrepreneurs. Really, we think about the world sort of in like three legs of a stool. First of all, we think that capitalism can be a tool for improving society when practiced correctly. Second of all, we think that there are really smart and talented people equally distributed across society, but sometimes opportunities are limited either by geography or our own unconscious bias. So we focus on finding entrepreneurs wherever they are, both in the regular places, but also looking in underrepresented for underrepresented founders and underrepresented communities. And finally, we're focused on ideas, we call it urban resilience, but anything that makes living in the city more just, more joyous, more equitable, more prosperous, more profitable for everyone. And as of late, we've been thinking about this idea, what I'm calling equity tech, or technology, companies that are using technology to break down barriers. So that could be anything from food delivery to better access to medicine, or re-engaging returning citizens. So we're from a tactical standpoint, we're pretty typical. If you understand the accelerator business, we have an accelerator which we just have recently taken all of our content online, which has allowed us to expand our reach, which is something really exciting for us and great to sort of think about what we might do in Philly in that regard. But an accelerator, we take in anywhere between 10 and 30 or 40 companies twice a year. We put them through a pretty intense 16-week training program. And now at the end of that training program, we make decisions about which of those companies that we want to invest in. Our platform allows the companies to continue to work through their issues, through their building their business. So we like to say, even if we say no, we're trying to make it a sticky no, so we can watch companies as they progress. But we usually invest in somewhere between 5 and 10 companies in each cohort. We just, as Victor mentioned, we just finished a cohort. We're in the process of making our investment decisions right now. We're also in the process of raising a new fund. Yeah, I'll leave it there. I know, Jake, you wanted me to keep it brief, so I'll leave it there and open it up for any questions. I can go deeper on any of that if people have specific things they want to talk about.
Awesome. All right. Thank you, Jeff. Let's get to the questions. So if you would, I think these always play out best if we keep it as conversational as possible. So if you would, for your questions, please, just unmute yourself and feel free to ask your questions directly to Jeff. And then if we do run into any issues of crosstalk, we can just start saying you have a question in the chat and I'll kind of queue you up.
I guess I have a question.
Yeah.
When you say you give them like 16 weeks of training, like what kind of training? Is this like research methods? Is this financial training? Like, what do you mean by training?
So it's a good question, Ben. So part of it is sort of the way that we think about the world. So I was involved in writing a couple of books as a consultant a book called Firms of Endearment, another book called Conscious Capitalism. So if you've been sort of following the news lately, excuse me, there's been a lot of talk about this notion of stakeholder capitalism. The Business Roundtable in August of 2019 put out a new statement on the purpose of business. So a lot of what we do is train entrepreneurs how to operate their business with a stakeholder mindset. And that really is about four things in particular. One, how do they articulate purpose, a purpose greater than just making money? Two, what sort of leadership frame do they want to use in that business? Three, how do they build a culture around those two things? And then the fourth thing is, how do you actually manage a business for all of your stakeholders and not just myopically focus on shareholders? Now, sometimes when I say that, people think, the socialism word comes up. I am a capitalist. Shareholders are stakeholders, but they're not the only stakeholder. And in fact, when you recognize that you have more stakeholders than just the shareholders, and you do what we call take off the shareholder blinders, you actually start creating more value for those other stakeholders, employees, suppliers, communities, customers, and therefore creating more value for shareholders. So that's a big component of what we do. We train entrepreneurs how to think that way and to show them what it means to build businesses like that. What do you do on a day-to-day basis? In addition to that, that's what we call working on the business, right? As opposed to working in the business. We often get what I always say are engineers, right? And I use the term loosely. It's someone who knows how to do the thing that they're trying to, accomplish, whether it be a mechanical engineer, someone who's trying to solve the water scarcity problem, someone who's building widgets. They know how to do that thing. That's the in the business part. And what we help them do is understand the on the business part. So how do you create a business around that? And then our platform, one of the entrepreneurs that went through the program this year called it Wiki for Entrepreneurship. We built an online platform that has about 400 hours worth of content. And that content is around four pillars, or four swim lanes, we call it. Governance, or we call it leadership, but it's really governance, product, market, and finance. And what we do, when we take companies onto the platform, there's an intake analysis. And we're looking to see, are they in alignment across those four swim lanes? What do I mean by alignment? If you are, I think Federico said that he was an investment banker. So if you have someone who has a particular expertise in finance, but then they see a problem they want to solve, name it, they want to make plastic forks. I'm just making this up. What you'll often find is that if the person has a finance background, they'll spend a lot of time building out financial models and sort of understanding what the P&L should look like. They haven't spent a lot of time, often when they get to us, understanding who needs plastic forks, what type of plastic forks do they want, and how much are they willing to pay for them? Are they really going to buy them? Those sorts of things. So product and market. So they may have spent a lot of time in finance because that's what they're good at, but they haven't spent a lot of time in product and market. So when they come into our program, once we recognize that, we'll say, okay, we're not going to spend a lot of time in the next 16 weeks on finance. We're really going to get you into the market. How many people are buying plastic forks? What kind of forks do they want? Where do they buy them? What should your distribution channels be? All of that stuff. Because what happens is if you're out of alignment that way, that you'll end up wasting time. And waste is, sort of the enemy of success, right? And then the other thing we want to understand is how quickly do entrepreneurs get things done? So if you see those four swim lanes, if you're back here, we'll give you sort of phase gates. We need to have you go into the network and understand how many customers want these types of plastic forks, and we'll give you a process for doing that. One thing we're looking at is how quickly do the entrepreneurs move through that process. So this is what we call alignment and metabolism, right? So we're looking for those two things in entrepreneurs as they go through the program. So to the specific answer, Ben, we're training on this idea of conscious capitalism. What does it mean to manage, to build a stakeholder-focused company? And then we're working with entrepreneurs to see how to help them progress along those four swim lanes, sort of governance, product, market, and finance.
Jeff, so in your intro, you kind of you outlined for us what conscious means for you in terms of your investing, but I was just wondering, how would you define conscious when it comes to the companies you work with? Are there like specific parameters in terms of their mission, how they hire employees or partners they work with, or
Yeah,
anything like that?
it's a great question, Jake. I mean, I think that when, obviously, you might imagine when people hear our spiel and hear me talking about this idea of conscious or stakeholder capitalism, lots of social entrepreneurs are attracted to us, right? So sort of typical social entrepreneurs who are using business to solve an environmental or a social problem, right? We get that. We like those entrepreneurs, and we invest in a lots of them. But that's not specifically what we're all about. So when we're talking about a conscious business, we're talking about a business, one, who understands that business is about more than just the money. It's about what value you create for a society. And then it's about, that's sort of the core of this. And then it's about how do you engage with all the rest of those stakeholders, right? So do you believe that your job is to create a trade-off between customers, employees, and shareholders? So you view employees as a cost to be managed, as opposed to you view employees as an asset to be leveraged, or an asset to be that you can amplify in some way, right? So it's really a nuance of shift of mindset. One of the things that that we talk about often is that we're transforming capitalism. Joe Carlini said to me once, well, we're not really transforming capitalism, we're transforming capitalists, because we're getting them to think more holistically about their business. But at the end of the day, Jake, I think that the simple answer to your question is that we believe that that if you create your business such that you're trying to create a mutual exchange of value consistently amongst all of those stakeholders, one, you'll do great things in the world, because the sort of punchline is, if I want you to care about me, I should care about you first. So we're creating these cultures of caring because we're trying to get employees, suppliers, communities, and customers to care about what we do. Because if we do that, we'll get really great benefits from them, right? We'll get discretionary effort from employees. We'll get customers who buy more and spend more and give us the benefit of the doubt. We'll get suppliers who bring us innovations. We'll get communities who welcome us in. And if we get those things, guess what? We'll create more value for shareholders, right? So we're trying to get our entrepreneurs to think more holistically about the purpose of business.
Sorry for joining late. I thought it was at 3, not at 2:30. But sounds really great, actually. I did, a few years ago, I did a TEDx talk in the Czech Republic about conscious capitalism. So it was kind of weird to be now part of this this discussion and to see what you're talking about. So
that's great, David. How did you come to the conscious capitalism idea?
I was torn between. I was actually volunteering for an NGO in the Czech Republic, and I saw that there was like and I've worked. Otherwise have been working, and I saw that there was a big disconnect in terms of like NGOs can't do what for-profit do, and for-profit don't have the same kind of drive in terms of having a purpose. It's just for-profit. So I thought, why not incorporate corporate social responsibility right from the get-go? And yeah, I'm actually now building a startup that's focused on that. So the profit, it will be driven right back into the company and the people. Yeah, I want to make it a transparent, flat hierarchy, transparent in terms of all salaries, costs, and everything. Employees decide how we spend the money. I'm just like I'll be the CEO, but that's only a title, just so I can sign the documents. But I'm really wanting to build a company that everybody is a shareholder.
Yeah. So there's a continuum here, Jake and David, and sometimes we talk about this. Look, in some ways, for-profits need to be more like not-for-profits, and not-for-profits need to be more like for-profits. What I mean by that is that in for-profits, as soon as we start to understand that it's not all about the money, we start to be able to create more value for lots more different constituents. And in the not-for-profit world, money's not a bad thing, right? We shouldn't think about money and profit as a dirty word, right? Because the reason that for-profit, look, I always say nothing's ever changed the world like a motivated entrepreneur. Not an army, not a government. Sometimes, I went to Catholic U with a couple of people on this call. Sometimes I say not even a religion, and I get pushback for that. But it's really hard when you see a motivated entrepreneur. It's, they can move the needle on things. And that, Raj Sisodia, who wrote Conscious Capitalism, who teaches at Babson College in Massachusetts, lots of his students will come to him and say, Dr. Sisodia, I have this great idea for a not-for-profit. And he's been of late saying, that sounds fantastic. Come back to me when you figure out how to make money at it, right? Because we know that the capital that's required to create really big systemic changes, it's easier to get that capital if you can return that capital and give a decent return on it. So when you're trying to create real big systemic changes, there's a reason why we want to look at doing that within a for-profit structure. Now, that doesn't mean there isn't a room along this continuum for not-for-profits. There is certainly things that NGOs and not-for-profits are better suited to do, and we want to support them. But we try to think about how do we create the most impact, and oftentimes it's through the realm of a motivated entrepreneur who's trying to create value for all of those stakeholders.
That resonates really well. I'm glad that I came late and didn't miss it. So,
Hi, Deb. Sorry, go ahead, David.
For me, it's a big. I have a big challenge because I'm basing it on technology like AI, mental health startup to analyze digital habits. So I'm asking for a big investment for someone to believe that I'm going to change the world.
Yeah, look, I mean, there's a lot of sort of emerging sort of, I guess, corporate structures that are sort of heading towards sort of some of the ideas that you mentioned. I don't know if you've looked at the work around the holacracy and some of the work that Tony Hsieh was doing before he passed away in Vegas. It's worth looking. I don't think it's for everyone, but it's worth investigating. So. Deb, you had unmuted there for a second. Do you have a question?
Yeah, it's tough to coordinate this. Good morning, everyone. Hi, Jeff. I'm just going to quickly introduce myself because I think I jumped in late. So I'm Deb Datta. I'm the founder and CEO of Viora Health, and we are improving access to care and reducing episodic costs by addressing social and behavioral barriers that are standing in the way of health and actually driving 80% of outcomes. We've had a positive response through a paid pilot, and we are in fact raising a pre-seed round of $750,000. So the talk is very timely. So the two questions that I have for you, Jeff, are I just did a little bit of research yesterday. In terms of our work, it's very aligned with doing well while doing good. My question is, in terms of stage, do you also, you talked about investing and, at the angel level, do you also invest in companies that are not doing the program? And, if so, what kind of companies, do you invest in? I wasn't able to find sort of your portfolio companies. Is there somewhere that I can look them up?
So 98% of the companies we invest in are companies that come through the program. There's a reason for that. The reason for that specifically is that this whole notion of stakeholder capitalism, it's something that if you haven't been trained on how to think about it, it doesn't necessarily come naturally, right? Lots of people, when we tell them the idea of, here's what we do, here's what we think about stakeholders and who they are and how you should manage stakeholders, they nod their head yes, and they say, yeah, that sounds great. But doing it on the ground, it's not an intangible. It requires some specific capabilities that we think that we're really good at training companies how to do. So we generally do not invest in companies that don't come through the program. Now, that's not a hard and fast rule. We have invested in a few companies that weren't in the program, but we knew the entrepreneur very well in some way, shape, or form. We knew another program that they went through. So we had a high confidence that they thought about the world the same way that we do. And that's both, there's two reasons. There's a performance reason behind that. We actually think that those companies are going to be better managed businesses and they're going to be higher performers. And therefore, when we tell our investors what we're investing in, if we don't do that, we set up, that creates a danger for us, right? Someone has a massive blow up, and the blow up is because they weren't operating with a stakeholder mindset, and we invested in them. They didn't come through the program. That's a problem for us. So generally, we invest in companies that come through the program. In terms of the types of companies, like I said earlier, Deb, we think about this sort of thing, this basket of ideas that we call urban resilience. And it can be anything from the access to healthcare, to helping returning citizens, to food access, to all sorts. It's a pretty big basket. So we're not typical, like we're, sort of healthcare SaaS. You're not gonna go on our website and see, oh, these guys only do, sort of, mental health apps or something like that. It's a pretty broad basket. It's not completely agnostic, but it's a pretty broad basket. So we would say that if you think that you have an idea that is either breaking down barriers, and it's obviously, improving access to care, it fits, right in the bullseye of what we do. So, it seems that what you're doing would definitely fit. Let me stop there. I feel like I was rambling a little bit.
I have a question, Jeffrey.
Well, let me, before you, Ben, Deb, did that answer your question?
Sorry, I was unmuted. Yeah, thank you. Is there a place that I can see, the companies that have been through your program and sort of just look them up in terms of, where they are in terms of stage, and such? And the work that they do?
Conscious Venture Lab website, we haven't updated it with the last round, but there's most of our portfolio companies or if you're, Jake, thanks, Jake. And if there's something specifically you're looking to find out, you can just ask me, or I'd be happy that you can go on our website and send me an email.
Sounds good. I was on the wrong website. Thank you for sharing, Jake.
All right, Ben, you said up next.
Please, that other guy had a question. I've already asked a question. I'll ask after him, that other gentleman.
Yes, thank you. So sorry about that, Deb. I didn't mean to cut you off. Question about pivoting. Obviously, your program is advanced and long, but as a startup, companies spend anywhere from 1 to several years building and getting investing. So during that time, business models change. As an investor, when you see progression of, say, branding change because just things have changed in the company or because of education or learning new things, does that show growth in a company, or as an investor, that show a red flag because the company has pivoted?
So it depends, right, Jesse? I mean, it depends on how many times, or how often. So if it seems to us like someone is, just sort of grasping for straws, that could be a red flag. But from our perspective internally, usually when the companies come to us, they're usually too early to have pivoted too many times. Right, we're doing, the companies we invest in are usually anywhere from zero revenue to about $500,000 to $700,000 in revenue. So it's an idea. We don't often invest in just an idea. They need to have shown some customer traction. some traction whatsoever, and we can define that in different ways. But usually there haven't been too many pivots. We see pivots during the program, right? Or after the program. And we're okay with that. Our idea is that we're looking for 8 teams overall, because we know that if you get involved with our community of people like myself and Chris and Joe Carlini, and we've got 100 other mentors, that those entrepreneurs who've done this over and over again are going to look at your idea and may come up with a way to say, hey, this is a great idea, but if you did this, it'll work better, right? So we're looking for teams more than we're looking for the greatest idea. Obviously, a great team and a great idea, home run. But we're looking for teams of entrepreneurs that we think are coachable, that have done some research, have done some work. So we're not afraid of pivots, but it depends.
Fantastic. Thank you so much.
Hey, Jeff, this is Troy Wilford. Quick question about the sustainability of the conscious capitalism learnings and the program that you put in. Do you have a sense for, and I don't know, how many alumni companies you have, but the sense for, as these companies grow and start to address the outside pressures that markets will obviously put on companies. Do you have a sense for how sustainable these teachings are, and do you instill in your program tools to make sure that there are checkpoints to ensure that the companies are continuing to follow the conscious capitalist mentality?
Yeah, Troy, that's a great question. It's difficult, and it gets increased. Well, there's 2 things. The torque steer of regular money will pull you off the path, right? So one thing we're trying to do is to create a community of investors that we can point our entrepreneurs to when they need to raise additional capital. So that's one thing, because we want aligned capital. We think things are changing though, right? I'm drawing a blank on who it was, but 2 weeks ago, someone announced that the first publicly traded company to change its charter to a benefit corporation. That's a big thing in our world because it hadn't been done before. And I know there's a movement right now to get Walt Disney, to change their charter to be a benefit corporation. That would be, that would be huge in terms of this idea that you could sort of memorialize the practices of conscious capitalism or stakeholder capitalism in the charter of your business, even if you're a publicly traded company. What we find now is that if you think about the Container Store, which is probably the company that's gone through this whole entire, or Whole Foods even, that's gone through this whole entire spectrum, started as a stakeholder focused company, grew tremendously, raised private equity, then went public. If you talk to Kip Tyndall from the Container Store, the public markets don't understand what he's trying to do. They have one metric, it's same store sales. And if you're not hitting that metric, then his stock has been killed. But he's continued to grow that business. He's now no longer there, but the business continued to grow based on the ideas that he instilled from day one. But now it's much harder because the public markets don't really sort of care as much about that. We see that there are publicly traded companies who sort of are under the radar and operating this way, but not sort of saying, we're a Container Store, or, they're just going about their business. And in fact, those businesses that are operating that way, they continue to perform very well. So there's a couple of public equity products that we run, and one of my old partners runs, that are, we're doing research to identify companies that we think are practicing like this. So there are some out there. It gets harder as you get bigger. The easy answer, and I think the third part is, what are we sort of looking at to make sure they stay on a path? The most important thing that we can do is have them give us measures of culture, because at the end of the day, culture is the thing. So how we treat each other within the organization, how management treats the labor, how labor treats each other, how they treat customers. That's the thing that we can see most readily. So if we said one measure, we want a measure of culture. And there's a bunch of people out there who do it, and we avail our entrepreneurs to those resources. We actually put that in our information rights. So when we're investing, we want, finances, we want all the regular KPIs, but at some point we're asking them to give us a measure of culture as well.
You've got me so excited about being here today. Sorry that I'm saying it again. It's like, I feel like I found my tribe.
We hear that a lot, David.
and I'm better late than never. I'm glad that I found this. I have so much in my head right now. I'm just in the process of getting things together. Like, I've done a lot of research, but what would you suggest, like, in terms of to focus on as a new founder? Like, how to say, what's the one thing that most startups miss, that even if they have a good idea in the beginning?
Well, I think that, it's probably two things. It's one, this idea of culture, right? So how do you create a culture? Most startups are like, I don't have time to worry about culture. I got to worry about sales. I got to worry about execution. And what we tell our entrepreneurs all the time is that culture is the thing that drives sales and execution. So you got, the minute you have more than one person in your business, culture is going to arise. And either you can drive it or you can let it drive you, because you'll have a culture. It just may not be the one you want, right? So as soon as you have two people, you have to start worrying about that. You have to start thinking about it. So
I'm on my own so far, so that's good to know. That's good that you raised that. I was thinking about that, but now that you said it, I mean, it was not at the forefront. It was an important thing, but now that you said that, it kind of rings true with the saying that it's not about the idea, it's about the people or the team that you invest in people, not in the idea.
Right. And I think the other thing, David, is that, this notion of articulating out loud the purpose of your business, right? A purpose that's greater than just making money. Making money is, so we say when you separate purpose and profit, you leave room in the middle for bad things to happen. But when you articulate purpose well, it does, I said this earlier, right? It gets all of those stakeholders more engaged in your success, right? So, and the ones that matter. So when I talk about our businesses that we're trying to create new paths for prosperity for underrepresented communities, there are certain people who that resonates with. Some of those people are the people who work for us, right? And since it resonates for them, they feel that they are part of something bigger than themselves. You know what? They want to make as much money as they possibly can. So do I.
Yeah.
And how do we do that? By getting them to feel that they're part of something bigger than themselves, allows them to give more effort, to give discretionary effort. I can't pay them to do, I say, I want to pay you to do, I want you to do more than I pay you for. By its very definition, I can't pay you to do more than I pay you for. It doesn't matter how much I pay you. Whether I'm paying you $10 or $1 billion. If I want you to do more, I can't pay you to do more, right? That's the nature of the statement. So how do we get people to do more than we're able to pay them for? It's by getting them to believe that they're part of something bigger than themselves.
I love you're preaching to the choir. I'm really, the words are like coming from my soul, even though you're saying them. Yeah, I'm basically, just to say the one-liner, I'm building a health tech startup to understand the mental health and emotional well-being impact of digital habits. So that's my one-liner. And thanks to Corona, I think, it's necessary. We're doing all these things like Zoom and meeting and Skyping and whatnot, and we don't understand the impact. So yeah, I'm really, I've got to look into your program, but I'm really excited to have caught you today.
Great. Thanks.
All right, I know Ben had a question, but it looks like he stepped away, so I'll step in. Jeff, this is a question I've heard come up a couple of times on these sessions, and I've always thought it was a good one. How do you help or support the companies you work with? How do you help them develop their internal KPIs to help them focus on their growth?
Um, so I think it's, obviously the KPIs, internal KPIs are different for every company and every business, right? So we're just trying to get them to focus on what's most important for them. We have a thing that we do often when we're thinking about KPIs. It's called a traction engine. So it comes from an old story that I don't know other than, well, there might be a few of you who are old enough to remember the Thriller in Manila when Joe Frazier and Muhammad Ali. But when Don King was trying to set that up, he needed four things, right? He needed money for a purse, right? He had to pay the boxers. He needed a place to have the fight. He needed Joe Frazier, and he needed Muhammad Ali. If he had three of those things, he didn't have a business. The whole thing fell apart. He had to have all four of those things. So in our nomenclature, his traction engine, those were the four most important things in order for his business to gain traction, right? Now, he got a bunch of people in the hotel in Manila, and he was saying, I got Frazier, and he didn't have him. He was telling Ali he had, so there was some subterfuge there when he was building that, but we don't suggest that. But we ask the entrepreneurs, so what are the 3 or 4 things that you must have in order for your business to get to the next level? Oftentimes they'll say it's money. We're like, no, it's not money. It's the things that if you had them, money would just be naturally attracted to you, right? That once, Don King wasn't looking for money for himself at first. I need money for a purse. I need a place to have a fight. I need these 2 fighters. Once he had those 4 things, he was awash in money for himself. The money just came to him, right? Sponsorships and all that sort of stuff just came to him. So he said, I'm not worried about going out and raising money first. I got to go out and get those 4 things. So we think about that when we're trying to build KPIs. What are those 3 or 4 things that you must have? And then, so how do we get you from where you are to having those things? What are the things that we should be measuring to make sure that you're moving closer to getting those things? Could it be number of meetings, number of people on the app, or whatever it is, right? But it's that we start out with that thought process, that thought exercise. Tell us the 3 or 4 things that you must have in order for this business to go to the next level, whatever that next level is, right? And if you see, we've talked about the S curve, right? So businesses grow. There's no, we see these charts that say, a hockey stick, but it's never really like that. We grow a little bit, and we get to a peak, and we start to decline, and then we jump off to another S curve. So each one of those S curves can be another traction engine, if you will. But that's how we think about it.
Great, thank you. I love that parallel too. Ben, I know you had a question.
Yes, I was just wondering about how you established your rubric and system. Do you work with other systems, or did you develop that in-house?
So we started off developing it in-house, if you will. So Raj Sisodia, who wrote Conscious Capitalism, and there was a professor at the University of Virginia, a guy by the name of Ed Freeman, who wrote a book in the late 70s called Managing for Stakeholders. Ed's work was sort of the foundation of everything you're seeing now coming to light with stakeholder capitalism. And so through our work, we became familiar with those 2 guys, became good friends with them. So they helped us originally develop our original curriculum. Then we looked out, and those other rubrics that we found, Ben, business model canvas and the lean startup stuff. So we started in the lean startup world, and we still do a lot of that. And a lot of the content that we have on our online platform is derived from sort of the leading edge thinkers in the lean startup world. So we spend a lot of time reading and research who's doing what makes sense, what looks efficacious to us, and integrating that onto the platform.
Okay.
Haven't heard anything from the Drexel ladies yet. Yeah.
Well, I was actually going to ask, I don't know if you could describe to us the process of what or how your firm goes about raising a new fund. I know you mentioned that you said that you're in the process of doing that. And I don't know if you could briefly chat about like what that entails from your perspective.
Yeah, well, it's a little bit different this time around than it was the first time around. The first time around, I went to people like Chris Vino and said, "Come on, man, I've known you forever," and he said yes. And we got a bunch of those people to say yes, and that's how it started the first time around. But that was early stage and tongue in cheek, but really we start out with friends and family, people that we've known, high net worth individuals who've had success, who've known what we were up to, and sort of had a penchant to sort of believe what we believe. But I think now that we've generated some success, we've showed some returns on the first money that we raise. It really is about sort of identifying the potential investors who are espousing, talking about some of these same issues. We don't want to spend a lot of time talking to investors who've already who've demonstrated that they don't care about the things we care. It's a waste of their time and a waste of our time. But it's it's a sales process just like anything else, right? We're out there doing research on who's putting money to work, and talking about these ideas of either racial, social unrest, bias, conscious capitalism, big intractable world problems, those sorts of things. And those are the sort of investors we're trying to get to. We expect to hear a lot more no's than we hear yeses. We have a lot of meetings. I had 30 or 35 meetings in the last 30 days. And then there's also the notion that, people like to follow smart money. So early on, when we raised the first fund, some of the first investors were people that other people in my network knew. And they said, well, if, Carlini is doing this and Vino's doing it, then those are smart guys and we want to be involved too. We were able to get Kevin Plank from Under Armour to invest in our first fund, and Steve Bisciotti, the president, owner of the Baltimore Ravens. That generated some activity. And now in our second fund, we're really lucky that Mr. Bisciotti was the first investor who committed to our second fund, and he doubled his commitment from the first fund. So now when we're having discussions with future other investors, they're like, oh, okay, so some of the guys in the first fund are coming along with you. That's a really good sign. And one of those investors is a big name and he doubled his commitment. Those are really good signs. So it really is just, Alessandra, a pretty typical sales process. I mean, I could show you, I have a big CRM that tracks every discussion I have, and it tracks all the emails we send, and who's saying what, and so it's a pretty big sales process. But for us, it's a progression. We started with high net worth individuals, so friends and family, people we knew. We go next to sort of endowments and foundations, family offices, and then finally to sort of regular, sort of high, what we call institutional investors, which might be pension funds or corporate VCs or something. You have to sort of climb that ladder, because those at the top, those institutional investors, when we first started, we were way too small for them to invest. And we were on our first fund, they're not going to invest in us. So you have to sort of move up that ladder so you can get to those later stage investors.
Great, thank you.
Hey, Jeff, just another question on the investor side. I know earlier you talked about employees and getting people feeling like they're wrapped around a purpose and they're working towards something greater. How do you see that as a kind of investment pitch whenever you're trying to get new investors? I mean, obviously they're looking for a specific, they want a return on their capital, they want a return on their investment, but in terms of feeling like they're working towards a greater mission and investing in greater missions, how do you kind of see that balance between the monetary returns and then the value to society in terms of pitching investors?
Yeah, we're telling investors that the value that we're creating for society is the thing that is going to create outsized returns. And we're trying to show that. We're trying to connect those two things. We are not concessionary investors. We're not in this to lose money. We're in this to make money. We think it matters how we make that money. And we actually think that by investing in ideas that move society along and in companies that operate with a different mindset, that we'll actually be able to make more money, right? So we're very upfront about tying this notion that our investment thesis, we believe, creates outsized returns.
So I have a obnoxious question for the very end. When you add value to other stakeholders, that presents other opportunities. Do you find a way of like multiplying your investment by investing in the additional opportunities?
So, say that again, Ben. I'm not sure if I understood the question.
Okay, so if you're going to be focusing on stakeholders, then other people are going to be benefiting from your business practices. Which is going to create other opportunities. Do you ever target those supplementary opportunities for investing?
Give me an example so I make sure that I'm answering the question correctly.
A factory that pays its workers well is going to have, like, restaurants near those factories are going to do really well because the people are making decent money, so they're going to go spend their money at restaurants. Would you turn around and, one, invest in the factory, and then two, invest in startup restaurants near that factory?
Yeah, it's a good question. We haven't done anything particularly like that. I mean, I think that you will find sort of, because of what we're seeing from an industry standpoint, that we'll look at one thing and say, wow, that if you think about this is driving value in another industry. So we'll start to look, to seek ideas in that other industry per se, but not as specific as you just sort of laid that out, Ben.
Okay.
All right, we have just about another minute here. If anyone wants to squeeze in a final question here for Jeff.
Sure, I have one. So Jeff, can you go in a little detail? How early of a company do they have to be to potentially work with your lab? Or you could say, how too far ahead could they be?
Yeah, no, it's a good question. So if you think about our investment thesis, so we're investing $120,000 on a convertible note for somewhere in the neighborhood of 8 to 10%, right? So if you think about the companies that would be at a point where they could accept that, you got to think about their cap table, right? So if you had a company that was doing $1 million a year in revenue, they would probably have raised some money already that their cap table wouldn't be able to manage us giving them 120 grand for 8 or 10% of the business, right? They would probably be beyond that from what money they've raised already. That would probably represent a down round for them. So generally, we're investing in companies that are somewhere between 0 revenue and around 700 grand. I think if between 5 and 750, if they're already doing that level of revenue, if they've done it, if they bootstrapped it, then it works fine. But if they've raised money prior and they're beyond 700, 750-ish, it's not a science, it's more of an art. They're generally going to say, well, I don't know that I can accept that investment at this point. Now, we might find something we love, and I can go back to our limited partners and say, hey, we love this idea. We're going to do this deal, but we're only going to get 2% of this business. And the limited partners could say yay or nay, right? But generally, it's sort of in that range, 0 to somewhere in the 5 to 700 range, depending on how they'd raised money previously. If they're much farther than that, they're probably not going to apply to our program.
Fantastic. Thank you.
Great. All right. Well, it's 9:30, so that is our time. Jeff, I just want to say thank you again. Really appreciate you joining us and sharing your insights this morning. I think it's been an excellent conversation.
Yeah, thanks, Jake. Chris, see you later. Thanks for having me, Jake. I've been happy to do it. Please give my best regards to Tiffany, and hopefully get to see you guys down at the Science Center in person sometime soon.
Absolutely. Sounds great. And thank you, everyone.